Hey everybody, welcome to the seminar we're going to have on real estate professionals, solutions for tax and accounting to maximize the tax benefits of your business ownership. And remember, you're not a real estate agent, you are the owner of a real estate business. And with that, you're entitled to a certain number of deductions, you're entitled to certain tax treatments that we're going to go over this morning, and we're going to help you understand a little bit. You know, everybody says, the big guys get all sorts of tax breaks, and why don't I get those, and why can't I get this? Well, you can. You're eligible for those. It's really simple if we follow the right programs and the right directions to get us into that. Because remember, your small business, and that's what you have, is a very big deal to you. And we're going to tell you today, in just a few minutes, exactly how we can take advantage of some of those techniques. Now, what we do generally with a small business like yours, when we get started, we incorporate and we form a corporate entity that's called a subchapter S. Now, what that does is it allows you to become instantly two people. It allows you to become the owner as well as an employee. So you, the employee, will get a W-2 with federal and state taxes and Social Security tax withheld. Now, the portion of you that is the owner will get paid a subchapter S distribution, which is like a dividend. Now, that is not subject to Social Security tax. So because you're paying both sides of Social Security, that could be 15% of whatever income we show as your sub-S profit. Now, your compensation has to be reasonable, and it has to be fair, and it has to be reflective of the work you do. But we'll make sure that happens when we talk and when we meet and we decide what your payroll is going to be. I got great payroll folks in my office. They can handle it. They can take care of it, and everything will be in order with the government. Now, once we do that, once we create the entity, we got to figure out what expenses you can use against your taxable income. Now, what I like to do is divide your expenses into three categories. The first one being ordinary and necessary. Whatever you pay your agency fees, what you pay maybe in rent or things of that nature. Really easy if you have subcontract labor or employees. Those are easy deductions to remember, and most people get those properly. Now, the second one are what I call hybrid expenses. They're expenses that exist. Everybody has them, but because you and I are self-employed, we can take a deduction for some, most, or all of them. That would be things like your cell phone, maybe your home internet, your automobile expenses, and certain meals and entertainment. If you're taking clients out to dinner, if you're taking maybe coworkers out to dinner and you're discussing business and you're going over your business, then those are things you can probably take as a tax deduction. We can talk about that. Now, the third level of expenses that I like to talk about are what I call success planning expenses. And that would be expenses such as perhaps you have a family member that works in the business. So rather than hiring an outside third party, you hire your son or daughter, or even in some cases parents, to cover your maintaining your listings, sending out your mailers, doing your emails, and doing whatever communications follow-up need to be done. Now, anybody you pay there, you have to pay a reasonable amount of salary to, and we have to justify that the work was actually done. But in that case, we're shifting maybe some income from you at a higher tax bracket down to your children who might be at a zero tax bracket. So it could be a very powerful tool for you, assuming you can talk your kids into doing the work. Now, another one we like to use, very common, is we can put in a retirement plan. If you're the only full-time employee, you'd be the only one that would be eligible for contributions into the retirement plan. So what we can do is set up a plan, a SEP, a self-employed pension, or a 401k, and do something like that as a way of tucking away income for you. And that could also be a very, very powerful tool for you guys to use in your business. Now, another category that we can think about is, of course, your officer's health insurance. That is not directly deductible through an S corporation, but there's a way to back into that on your individual return. And we can show you how to do that. It's not a very difficult thing to do. One of the other things, and especially because you're in the real estate business, you have an advantage. You're always out there looking for properties to buy. You're looking for things you need in terms of investment. So if you, for example, have a vacation plan somewhere out of town, if you're looking at property, you're collecting business cards, and you're helping your client investors buy property, you can be out of town, out of state, whatever. It has to be a fair and reasonable trip. Can't go to Hawaii for a month and look at one piece of property and claim that was a business trip. But if there's a business aspect to that trip, you may be able to deduct a portion of that trip. And I think that's really, really powerful in terms of how we can take your personal expenses and put it on the company return. Again, has to be business related. You have to be actively conducting business while you're on that trip. So that's something, again, if you have any questions about that, call me and we'll meet and we'll talk about that, and then we'll go over it at that point. Now, there are certain things, tax treatments that we get in investing in real estate. And if you're working with investors, if you're doing investments yourself, you'll need to kind of know what these are. Now, one of the things we use is something called cost segregation. Now, commercial buildings are depreciated at 39 years. Residential buildings are depreciated at 27 and a half years. If we do cost segregation, what we can do is look at some of the light fixtures and say that's 5-year property, or this is 10-year property, or this is 15-year property, and then we could gradually or greatly increase the amount of depreciation we take, which lowers the taxable income on that particular piece of rental property and increases your cash flow. Now, the banks should be really happy about that, because the less money you pay to the government, the more you have to pay back your loan. So that can be a very, very strong thing. Now, everybody knows, and I'm going to change something, about what a 1031 exchange is in general state. If you own a piece of property, you can turn around and sell it and go through the form of the transaction is very important, but you can sell that piece of property and you can buy another one and not pay capital gains on the profit on the first property. So again, you have to use a qualified intermediary, and it's a very, very technical process you have to go through. But again, if you have a building, you can sell it. And I can remember a while back, I had a client, he had a vacation home down in Florida that he was using as rental property. He was getting older. He didn't want to go down there to maintain it and take care of it. So we sold it. We did a 1031 exchange, and he bought 2 rental properties in Alpharetta. Now, he was able to do that, pay no tax on the gain. So he was able to pay cash for those 2 properties, and he got good retirement cash flow from those two properties, being up here and being closer and being where he could maintain them. Now I've seen other people, maybe they own a building that their business is in for years, and then they reach retirement, they sell the business, they sell the building. But we do a 1031 and we buy a vacation property down in Florida. So we do the opposite of what the last guy did. But it's all custom to what each individual's needs might be, what your goals are, what you want to do. Now, tax credits. We have a lot of tax credits that are available. And I know I'm going fast, but that's what I do. We have a lot of tax credits that are available to us as real estate investors. We have certain amount of rehabilitation credits, maybe some ERC credits. If you have employees, there might be some employee tax credits that are available to you, and then possibly some for certain qualified historical structures. The benefits of those are a little bit, can be a little difficult, because once you get a building certified as a historical structure, it's really difficult to do repairs or improvements, because you have to keep it the way it was when it became a historical structure. Now, there are also things called, installment sale income, and that's when you sell a piece of property and they pay for it over years and you owner finance, and then you only have to pay the tax on the portion of the property or the portion of the proceeds that you get in the year you get those proceeds. So that could spread out your tax liability over a great number of years. Now, there's also a vehicle called the Deferred Sales Trust, which sort of takes some of the benefits of a 1031 and some of the benefits of a deferred sale of a 1031 and an installment sale, and puts them together. So basically, again, you sell a building to a qualified intermediary, they pay you over time, and then they receive the cash from the ultimate buyer, and then you only pay tax on the proceeds that you receive in the year that you receive them. Now, one of the limitations that the government has on real estate investments is they limit the amount of loss that can be taken in a given year. Under most circumstances, it's like a $25,000 rental loss that you can take per year. If you are a real estate professional, you are not subject to the $25,000 passive loss and limitation. So basically, if you're smart enough to invest, you're dumb enough to take a loss in excess of $25,000, I guess. I don't really understand the logic there, but there's logic there somewhere. But I guess they assume they know you know what you're doing, and they let you go ahead and do it. So again, those are some of the things, because I know your investors are going to ask you questions like this. They're going to ask you, what's cost center, what's 1031, what's a deferred sales trust? What, and another one, what type of entity should we put our rental property in? And most of the time, setting up an LLC as either a personally owned business, which is called a disregarded entity, or some sort of partnership is the best tool to put in a piece of rental property. Now, one of the things that's important, and what I see, is a lot of questions or a lot of situations aren't treated properly simply because the questions aren't asked of the tax preparer, the tax professional, or the accountant responsible. So you don't ask me, I don't give you a good answer. So what I try to do is I make sure that there's enough communication between you guys and me to make sure that you get the answers you need to even questions you don't even know to ask. Because as real estate professionals, your business is a little unique, and it's a little different than a brick and mortar store. It's a little bit different than a professional office, like an accountant or an attorney or a doctor. But it's got certain commonalities, right? So the things you have to deal with are basically the same things you have to deal with. And so we can kind of anticipate those questions because we have a little bit of experience in those areas. And it's worked for him, so it's going to work for her, is kind of the approach that we take on that. Now, here's a good example. Several years ago, I had a client, and he called me up. He was a real estate professional. And he called me up and he said, I'm going out of town to some seminar to learn how to make money being a day trader. And I kind of shook my head and I said, I don't really think that's a good idea. And let me tell you why. Because you are a real estate professional, you're experienced. You've been in that space for many, 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 many years. You understand real estate, and if there's big money for you to make, that's where it's going to be made. And so he, kind of dejectedly left my office. And unfortunately, one of the things that I do, I tell people I'll give you my opinion on 2 occasions. When you want it and when you don't. And unfortunately, when you don't want it is probably the best time or the most important time to be listening to me, because so many people, they get excited about this idea and they think they're going to make millions and they think they're going to do this and they get overwhelmed with enthusiasm and they kind of suspend reality a little bit. So anyway, a couple months go by and my friend comes in and he says, I found a piece of real estate that I want to buy. And it just happened to be right next door to his house. Didn't have to go to Seattle for the seminar. It was right there next door. The gold mine was right next door. So what we did was he bought that piece of property. He divided it into 3 lots. He built the first house on the first lot. He sold his residence, made about a $300,000 or $400,000 profit on it, tax-free because it was a personal residence. He moved into the new house. He lived in there for 2 years. If a house is your personal residence for 2 out of 5 years, it qualifies as your personal residence deduction, right? So he lived there for 2 years. While he was there, he built a house on lot number 2. When lot number 2 was finished in 2.5 years, he moved over there. Sold that, made about a $500,000 profit. Tax-free, him and his wife, $250,000 times 2. And then he did it again to house number 3. So he made almost $2 million profit among the 4 houses, tax-free. Now, he did have to move. He did have to live there. He did have to, build 3 houses. He was his own general contractor, so a lot of expense that would have been made for that house was saved because he did it himself. But it was worth it. It was worth it to him for sure. So I guess what I think we should talk about is when you start a business, and I know some of you are seasoned professionals, and hopefully these tax tips will help. Some of you are new in the business, so I will say this. I want to be there with you. I want to be there when you have your brilliant idea. I want to be there to help you implement it. When you experience success, we're going to do some success planning, and we're going to make sure that you get the best possible tax treatment for all the things that you are doing. Once we do that, we're going to go into what I call the legacy building stage, maybe creating some generational wealth. And one of the limitations in being a real estate agent, professional, owner of a real estate business like you are, is you don't necessarily have a sellable asset. You don't have a restaurant that you can operate for X number of years and then sell that restaurant to somebody else. That's not available to you. The market value of your business isn't as significant as maybe a brick and mortar business, or even a professional business that's got a book of business that is transferable and sellable. So that's why we have to come up with these other techniques. Maybe find some investment property that you get in at a good time, and you get in and you hold and you do that. And maybe we can sell those, like I said, on the installment sale over a period of years. Maybe we can contribute some to a SEP or a 401, solo 401k or something like that, and we can go over that as we go. Now, one of the ways your business is possibly transferable, and we'll go back to your kids. Yeah, your kid's 7 years old and he's helping you stuff envelopes right now and he's making minimum wage or whatever. But 20 years from now, he might be looking for a career. He might be interested, right? So raising him to the level of partnership so that business continues on might be one of the solutions that you can have to that problem of not having a business that you can, like I said, sell over time. Now, I will say this. I've talked to a lot of real estate people, and some people say, what is the business mistake that real estate agents make? Just based on my personal observation. And I say, well, I see a lot of people that go out there and they confuse getting the listing with making the sale. You go in, you give a particular business property owner a proposal on how you're going to sell the business. You get the listing, and it never sells. Maybe because that individual overestimated the value of the property. Maybe it was in a non-sellable condition, but you didn't really want to tell him that his purple walls looked bad, or you didn't want to tell him you got to repair this or you got to repair that. And then, yes, you were able to get them to sign up for the listing, but that property will never sell for what they envisioned it for. So those are things to think of, because of all the things that are valuable to us business owners, the thing that's most valuable is our time. So if we're setting ourselves up to fail by creating an unrealistic contract, then we're costing ourselves money, and we're costing ourselves a lot of value. So that's what we want to avoid if we can, and understand every thing that we invest time in has to have a certain return. And we have to remember how valuable your time is when you're working on something. That's why reducing your commission might sound appealing to get, but then what does your hourly rate become on that, right? And I think we all know, and we all have seen people, and sometimes the people that demand the lowest price are the ones with the highest of expectations of your time, and they're gonna be constantly nagging you, bothering you, and not only are they getting a reduced fee, but they want to tell you how to do your job. And I wish there was an easy way to say, we need to avoid those people whenever possible. I don't really know how to do it, because they I guess they're good at it, and they get you into that trap. And then all of a sudden you realize, I'm spending more time with this guy than I am with my kids, and his house is never going to sell, right? And we've seen that. And and it happens, I guess, in all lines of work. But I just want to say in closing, like I said, I'm John Q. I'm a CPA. I help business owners, work with a lot of real estate folks, and I definitely want to work with you. I want to help you I want it. I understand that your small business, no matter how small it looks like compared to whomever else, it's a big deal. It's a big deal to you. It's a big deal to your family. It's a big deal to your legacy. And so it becomes a big deal to me and my team. And yes, we're going to make sure that the benefits that the big guys get, tax-wise or otherwise, you're going to get if you're working with us. So I'd love for you to give me a call. I'd love for you to come by and see me. My office number is 770-395-0223. Everybody here should have that information. My email address is johnq, JOHNQ, @JOHNQCPA.com. And I love speaking to people. I much prefer spending my time nose to nose with you rather than my nose up against the computer screen. I think one of the first things people ask me when I walk into my office is, "Where's your computer?" No, I don't keep a computer on my desk, right? Just something I decided that I didn't think I needed to do, because concepts and ideas and strategies are what is important to me, and it's important to you. I think a lot of times you might get a tax preparer that's like the cashier at the grocery store, and they just scan stuff in, bleep, 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 and it all goes into the system, and whatever the computer says is what it is. Well, you know what? There's a lot more that goes into that. And I know this is a silly example, but can you imagine you're checking out of the grocery store, and you're getting this nice, big prime rib, and the cashier goes bleep and bleeps it in and says, if you got this certain bottle of wine to go with that, that would make that meal complete. And that's what I want to do. I want to help you complete your business. And I want to be there with you. I want my team to be there with you. So let's get together. Let's meet. Maybe there's some strategies we can do before the end of the year. Get this stuff rolling and in place. And I wish you all the success that you deserve. And we'll see you soon. And thank you very much for coming in. And I look forward to seeing everybody soon. Thank you.
Thank you, Doug. Thank you.